Okay, so let's go over a little more technical and think about how a central bank actually controls the money supply. What does it actually do? We talk about money and the, farmer alfalfa paying things, and talk about the Fed. So how does it connected? What is the connection between the two? How does the central bank actually? So how does the Fed control the money supply? Well, if there was just currency, like farmer alfalfa, it would be pretty easy, because all the money were currency, then the Fed just prints it, and that's the amount is determined. But that's not the real world, because we want to think by definition is part of money is what you have in the bank that you can make for payments. So that would be deposits at banks, deposit at Wells Fargo, Bank of America, wherever it happened would be. So the Fed has to control not just the amount of currency, but the amount of deposits in the economy. And so how does it do that? Well, let's think about it. Let's use some symbols. So money supply by definition is currency plus deposits. That's just symbolically how it's represented here. So we know that the Fed can print the money, and so it can control currency, but it also can control deposits at banks. So how does it do that? It does that, at least in principle and theory, because there's a connection between the amount of deposits you and I have at banks and the amount of deposits that the banks have at the Fed. Those are called bank reserves. So just by definition, bank reserves are deposits that a commercial bank like Wells Fargo holds at the Fed. So they have a checking account at the Fed, and that's what reserves are. Bank reserves, again, are just deposits that commercial banks hold at the central bank. There's an equation which describes the relationship between bank reserves and deposits. There it is, bank reserves is little r times big D, so R is called the reserve ratio by just a definition. So for example, if the reserve ratio is 0.1, then banks hold reserves equal to 10% of deposits. Now that implies, of course, that there's a connection between the amount of deposits, that's part of the money supply, which we're trying to determine, and the amount of bank reserves. So if the deposit ratio is 0.1, then deposits are 10 times bank reserves. So if the Fed can just determine the amount of bank reserves, and if little r is constant, then it can control deposits as much as it wants, and therefore it can control the money supply as much as it wants. And currency by printing, and the deposits by controlling the amount of bank reserves. So how does the Fed control the amount of bank reserves? Well, bank reserves are just deposits that banks have at the Fed. So it controls that by altering the amount of reserves in the economy. And it does that by buying and selling things. So just read it, by buying or selling things and paying or getting paid with the reserves, the Fed can determine the total amount of reserves in the economy. Now the Fed could buy and sell anything. It could buy and sell ketchup. If it bought ketchup, it would pay for that with deposits. If it bought ketchup from Wells Fargo, it would pay for that with deposits that now Wells Fargo has at the Fed, okay? Of course, there's not enough ketchup around to make any sense of this. So instead they buy something which there's tons, and that's government securities, government bonds, government bills. And so that's what they do, mainly buy government bonds. So buying and selling government bonds, which is called an open market operation, by the way, because the Fed goes out and buys or sells these. But when it buys these, it credits banks. It pays for it, not with currency. It pays for it with deposits that the banks have at the Fed. And so it can increase and decrease the amount of bank reserves simply by buying and selling bonds. And that's how the Fed controls the amount of bank reserves. So given that, you got the answer. So summary, money supply is the sum of currency plus deposits. Currency controlled by a printing press. Supply of deposits controlled by altering the amount of bank reserves. And the Fed can determine the amount of bank reserves through these open market operations. Again, buying means you're increasing reserves, increasing the money supply, and selling is the reverse. Now, this connection between bank reserves and deposits, if it were steady, we'd be done. The problem, and this is really becoming where we get to more modern events, things that have happened recently, that ratio is not constant anymore. And that's made monetary policy even more difficult than in the past. And so I'll give you a picture of that. So again, if R was pretty steady, and it was very steady, as you'll show you in a minute, for a long time, then the Fed, whether it's through Burns or Volcker, whatever, would be able to control the money supply, bring money growth down by just changing the growth rate of reserves. However, things have changed. And this is an illustration of that. This is a picture, it's actually produced by the Federal Reserve Bank of St. Louis, of reserves. It's the blue line, and deposits. It's the red line, deposits at banks. And you can see until the financial crisis, mid-2008, this is a very steady relationship. So that's the stability of R. And so the Fed could just change money growth by change deposits, by changing bank reserves, open market operations. But look what happened. In the crisis, the Fed actually increased the amount of bank reserves by gigantic amounts, so much so that the connection between the deposits and bank reserves was just thrown out the window. That big increase in reserves occurred as the Fed bought tremendous amount of securities and paid for them for reserves. So at this point, it said, well, they were forgetting about the money supply before this. Let's just forget about the money supply. We got a crisis on our hands. That's what they said. Ben Bernanke was the chair. And they just increased the amount of reserves tremendously. And the mechanism is simply, we want to buy government securities. I'll talk about why that's the case in a minute. We're going to have to pay for them by crediting Wells Fargo, Bank of America, whatever bank it happens to be, with deposits on us, and that accelerated. And so it severed this relationship, and now it's more difficult to use this classic method to control the money supply, unless, of course, we move back to a situation where that ratio is fairly constant again. Okay, so it's a great complexity that's been thrown into the system as it exists now. I call this Top Gun, School of Central Bankers dedicated to teaching the science and art of monetary policy, because it has gotten a little more difficult. And I want to do this by first discussing a very important aspect of monetary policy, which I'm very interested in, that is how monetary policy should be operated. Should it be operated with this powerful organization having complete discretion to do what it wants, or it should be under some oversight, which exists, of course, to some extent? What degree should there be? And as it does that, how predictable and accountable should it be? So this debate about discretion versus rules, accountability, has gone on for many years in economics. Milton Friedman wrote much about that. And there's people who are in favor of rules. That's people like me, because rules are predictable. There's more accountability if central banks are following rules. It's easier to tell new central bankers what to do. Many people are appointed to be governors of central banks. They've never been involved in monetary policy before, but this helps them explain what to do. And there's also this problem of time inconsistency, which you'll come back to, I'm sure, later in this boot camp, where there's a tendency for central bankers to change policy over time, not be consistent. And so it's time inconsistency, and there's reasons that happens, but if they have a strategy or a rule in place, there's less tendency to do that. They're sort of describe what they're doing, and it's harder to change. Of course, there's others who argue much more in favor of a more discretionary approach. And in some sense, you go, well, of course, you can't have a rule or something written in stone. You have to be flexible. The world changes. You need flexibility. That's one of the reasons for that. And of course, no matter how good a rule would be, there is reasons to deviate from it over time. And so I want to consider an example of a rule to illustrate these points. And the example I want to consider is based on these common sense ideas. So we're now kind of moving away from the money supply, for a minute at least, to think about the interest rate that's implicit in that money supply decision. Okay, so the Fed is, you will hear it deliberating about what the interest rate is that they're setting. They don't talk about the money supply very much. So we need to move to the interest rate, and we'll come back to the money supply connection in a minute. or 2. Okay, so these are just sort of questions. Should the FOMC raise interest rate when inflation rises above a target? Well, the answer is yes. That will tend to slow the inflation rate down. Should it cut the interest rate when inflation falls below the target? Yes, the idea that will speed up inflation. And same with GDP. Should the FOMC raise the interest rate? If real GDP rises above the normal rate, potential GDP of the economy, yes. Should it lower rate when the economy is in a recession or GDP falls below? So most people would say the answer to all this is yes. And so a rule would be, how do you describe that process in a way which is more than just a multiple choice, all the above question? And one way to do that is through an equation. And so this equation at the top, which has come to be called the Taylor rule, is just simply a way to articulate that, but with specific numbers. Little r is now the interest rate, federal funds rate that the Fed sets. P is the inflation rate now, percentage change in the price level. Y is GDP, but it's measured as a deviation from potential GDP. I'll show you a picture about that in a minute. And the rest are just numbers. So this rule, designed many years ago, has as the target for the inflation rate 2%, because P minus 2, it's P minus 2 that calls for an increase in the interest rate. So when the inflation rate rises above 2, the Fed's supposed to raise the interest rate. If it's below 2, they can lower the interest rate from what it otherwise would be. Y is there because when the economy is in a boom, Y is positive. The economy is more than its potential, should be raising rates. If the economy is in a slump, like recessions we sometimes have, then the Fed should be lowering interest rates. And again, the coefficients are not insignificant. They become now becomes a rule which you could be describing and discussing. Okay, so that rule is now called the Taylor rule. It obviously can be written in a different form in the blue circle just by rearranging terms. But it says that the interest rate should rise by 1.5 times the inflation rate, plus 0.5 times the GDP gap, plus 1. And that's the rule that the Fed has talked about very much more recently, but has in the past as well. Okay, this is where, when this thing was originally proposed, things looked like. This helps you, I think, understand what's going on. So over on the left is real GDP compared to potential GDP. If you can't see the years, that's the late 80s and the early 90s. And so you can see the economy goes above potential in a boom, then it comes down in a recession. That's big Y, little y. The inflation rate, you can see it going from 3 to 4.5 and back down again. And at the bottom is the interest rate. That's the Fed's interest rate, what they're setting. So these are old data. That's the point. And you can see that the federal funds rate, that's the decision that the Fed was making, was deciding on, the issue the Fed was deciding on, the federal funds rate, and the policy rule is in dotted. So it tracked almost exactly for those coefficients, 0.5 and 1.5. And so this, way back when, attracted a lot of attention at the Fed, and so they've continued to look at this, continued, and other central banks have as well. What has, I think, interested people more, especially over time, is that this rule actually can be used, not perfectly, not mechanically, but as a guideline. So it was never meant to be used mechanically, so a rule doesn't have to be a mechanical formula. At least that's one of the lessons of what we're doing here. And you could think about it, it just looks at the rule. The FOMC looks at a rule, other central banks look at rules, and they may look at other ones too, not just the example that I'm showing you right here. So that's rules-based monetary policy. The interest in this idea accelerated a lot over time. It actually diminished, and I think it's coming back again, but accelerated a lot because people began to look at not just this 87 to 92 period that I showed you, but before then and after then. And they say, well, when it was not close to the rule, things didn't work so well. When it was close to the rule, things worked well. And so, in some sense, it validated. So this is, I think is a still very important point, and I have a picture for this. Again, whenever I talk about this so-called Taylor rule, I can't use my own research because people will say I'm completely unobjective, which I am, of course, but even though I try to be objective. So I use other people's research. This is from the San Francisco Fed, and they show you that when the policy described by the solid line was close to the rule, things got better. And before then, that terrible period I showed you with Burns, it was terrible earlier because you're way off the rule. So it's another way to look at this. It's consistent with the money supply way to look at it, but it's different, but gives answers which are comparable. So bad policy, interest rates in this case were too low, and that stimulated the inflation rate. So that's the period before the 87, 92. 97, 92 looked pretty good, things were getting better. There they are, better, worse. And then you look at different periods. This is much later. This is by the Federal Reserve Bank of St. Louis. The president then, William Poole, did the same kind of calculation, but he goes into more recent periods. So the black line is the federal funds rate, that's their decisions. He's listing the parameters of the so-called Taylor rule at the top of his picture. This is just a replica from his paper. And then he shows the interest rate was really pretty much on track, but then started to get off track in 2003, 4, and 5. And that off-track period is where I think there was quite a mistake in the way policy was operating. So that little period at the end, which is, in this case, Bill Poole, but others are beginning to think, well, maybe we held rates too low in 2003, 4, and 5, and maybe that was part of the problem, has become a real issue for discussion. And in fact, this picture from The Economist magazine illustrates that. So all this is a picture at the end, which illustrates that policy was off track according to not just this Taylor rule, but compared to what they did in the 80s and 90s. Too low for too long, and that's what it is. So The Economist, always clever in their headlines, calls this loose fitting. And so it's loose compared to that. And so what I would argue is this very low rate caused a lot of search for yield, so to speak, risk-taking, and ultimately was responsible for, at least partly responsible for the financial crisis that occurred soon thereafterwards. Okay, so there you could see on the rule, off rule. And then finally this picture done by recent researchers tries to bring this all together. And they are dividing time into discretionary eras and rule-based periods based on that formula. The researchers from the University of Houston. And they just color the lines which they view as more discretionary and more rule-like. And you can see the deviations are larger in the discretionary period, that's by definition. And then given that, they look at the performance of the economy. So again, the discretionary is the pink, rule-based is white, and this is the results. So the term in the first row is the deviations of inflation from 2 squared, rules-based much lower than discretionary. And the second row is the deviations of unemployment from some normal level, U star, and 1.41 versus 4.29. So of course there's debate about this, but it's pretty clear there's some connection between the type of policy, whether it's rules-based or not, and the performance being much better for the rules-based policy. So that is when I say what works and what doesn't. I want to think of what works, rules-based, what doesn't, discretionary.